Hello everyone and welcome to your Glassnode video report. I'm your host Checkmate and we're recording this on the 25th of January 2022. Now today we're going to be looking at a fairly interesting topic, which is sizing up a Bitcoin bear. We've obviously seen some fairly dramatic price action. We've seen investors really fall into a pretty poor level of profitability overall. And ultimately what we're trying to assess is, has the investor sentiment changed in the same way that we've seen in previous cycles? So a big thing that I look at when we look at bear markets is it's a mindset. We're looking at, do we have the demand models? Have retail left the building? Is it only the hodlers that remain? And simultaneously, when we see spending behavior, are folks just trying to get their money back? Are we seeing capitulations? And are we seeing consistent profitability losses where people are essentially experiencing financial pain? So what we're going to look at here is this drawdown that we currently have from the all-time high, which is now broken above 50%. And what we're looking at is, how does that drawdown compare to previous cycles? Are we seeing the same kind of profitability metrics? What does the overall market sentiment look like on chain? And just trying to understand the underlying supply dynamics, particularly around the long-term and the short-term holders, understanding what they're currently doing with their coin supply and whether their sentiment has actually changed and what we can really garner from that in terms of what to expect looking forward. So it's going to be a bit of an interesting one. We're really trying to assess this from a big picture macro overview. And we're going to be looking at a number of interesting metrics like NUPL and various other that people request in comments on a regular basis. So looking forward to getting into this one, as well as some fairly unique, and I don't think people have talked about, particularly this realized price to liveliness ratio. I'm actually looking forward to taking you on a bit of an adventure through this one. Okay, so here we are in the week on chain 4 dashboard. And we've clearly seen a number of very, very painful weeks, right? This has now been going on for, it's not even weeks now, it's now months. We have seen these red candles pull us down. We get to 33,000 overnight. So some fairly dramatic downside price action. There's obviously a lot of the coin supply that is now underwater. And this has the potential / has affected investor sentiment. People who are holding coins underwater are going to be more likely to panic sell, to capitulate. And really what we're going to do here is just try and assess what has actually happened and therefore try and identify what we do or don't want to see for further bear side or to see some kind of reversal back to the upside. So as I mentioned, the current drawdown is actually, it's almost on par now. It was 50% when we wrote the article yesterday, but it has actually pulled down even lower today. And you can see it's now almost on par with the bottom in July. July was still a little bit worse, but you can see it's the second worst pretty much within the last 2 years. We really have to go back to 2020, where the previous cycle high hadn't even been taken out, to find a drawdown of this level. Now note that during the bull phase, and this was the same during 2017, we had corrections of 20%, 30%, 40% in the extreme, but during the bull cycle, very rarely do we get something that pulls down 50%. And given this is the second time this has now happened over the last 12 months, it is going to create anxiety in many of the investors who are holding coins. So we know that essentially the groundwork is there for a more bearish pattern. Now, what we can see here on the net unrealized profit and loss metric, our NUPL metric. Now, this one here is one that looks at how much profitability is still in the system. When we talk about unrealized, these are coins that have been purchased, moved into an investor's wallet, and remain holding the difference between the price when they bought the coins and the current price. Now, obviously, if somebody last moved their coins at 40,000 and the price was at 60, then they're holding an unrealized profit. And this value as an overall for the market is going to be in the positive. Now, conversely, when investors hold coins that are underwater, they purchased it at 40 and they're currently trading at 35, then they're holding an unrealized loss. Now, what do we see when we look at the NUPL metric? Well, we can see March 2020 was the last time we had a major capitulation event. This is where essentially the entire market, on average, is now holding underwater coins. So generally speaking, these very, very low values of NUPL typically coincide with major capitulation events, generally generational market bottoms. And you can see that we're certainly not at that level yet. We've moved into this yellow zone, which is kind of this intermediate phase where it's in the early bull. We can see this in 2020. We reached it down here during the May, June, July period. So that obviously scared some people because it's down under 50% profitability. It's now, people have seen the gains and then they've seen it pull back to a much greater extent. We had a relief rally as we pulled up to the October and November all-time highs, and now we're back down into this uncertainty zone. So let me just jump into the full scale of this chart. And what I've zoomed into here, and you'll see this for a number of the charts we're going to look at today, I'm looking at more or less from 2014 onwards for two reasons. One, I want to see what's going on in the previous bear cycles, 1 and 2 through 2018. And then you can consider 2019 was almost a miniature bear as well. And also, this is where we have more mature markets. When we look back at history that's beyond, say, 2013 even, it's just a very different market structure. So I like to look at more recent history to really assess these. And given we have two real major bear case studies, you could argue three with 2019, but this is really what we're going to use as our baseline. So you can see that in terms of profitability, we are now down below the July bottom. So overall, network profitability is not great. You can see that we tend to trade around this zone at the late stage or the middle through to the late stage of a bear, generally before some kind of major capitulation that puts the final bottom in. You can see that most of 2019, which is almost this in-between miniature market cycle, we kind of poked our head into high profitability, but investors did start taking profits at that point in time. So we did actually descend back into another 9-month bear. So we are in this intermediate phase where it's kind of generally we see it in the early bull, but it's probably more unlikely that we're in that phase right now. It is starting to look like we may have pulled back down, almost like 2019. We kind of poked our head above, and now we're back into the unprofitable zone. So overall, the market's not underwater, but it's also not exactly enjoying massive profits at this point in time. So it is one of those kind of intermediate periods, and it does add weight to a more bearish argument. Now, one thing before we move on from this metric that I want to highlight is actually, let's zoom in on our 2020 and 2021 bull. So note that as price in the gray here made higher and higher highs, what we saw is a rolling over. See how our metric actually had lower highs as price was going higher. This metric was actually pulling down lower. And then even so, we set a new all-time high here in October and November, but the NUPL metric was actually much lower than our highs back here. What's driving this? Well, this is actually a bearish divergence. What's happening here is that this metric is measuring how far above the cost basis or the realized price is everybody's coins. Now, if we're getting higher highs in price, you would think that the whole network should be more profitable. But what was actually happening is investors who had purchased their coins much cheaper were selling them to new hands at higher prices, creating a top-heavy market. Lots of folks who own coins that are actually up here in the top, and even more so during this top. So what this means is that the overall cost basis of the market, even though price is higher, people own coins at a much, much higher level. And as a result, there's more coin supply that needs to be absorbed. People are more sensitive when prices are around their cost basis. So not only do we have a bearish divergence in this metric that you almost told us that there was going to be a rollover at this point back here in May, we also had a macro. If we look at this on a big picture scale, we have a macro bearish divergence where more and more coins had been redistributed to higher prices, which therefore creates an overhead supply that then needs to be absorbed. So that's just an interesting insight as we look at this metric. What it's telling us is about the overall profitability and how coins have moved throughout the system. Now, another metric that tells us about the overall profitability is the MVRV ratio, which stands for market value to realized value. So the way to think about this, the market value is the spot price, and the realized value is the average price of every coin when it last moved on chain. So you can almost think about it like that's the cost basis for the market. If somebody withdraws a coin at 30,000 and leaves it in their wallet, we're assuming that the realized value there is their cost basis. It's never going to be perfect, but it gives us a pretty good reason for where people last interacted with their wallets, and therefore there's a psychological bias that gets built into those levels. Now, what the MVRV ratio, or in this case, it's a Z-score. So what a Z-score means is it's normalized. This is measuring how many standard deviations. It's a statistical measure about how far away it is from the long-term average. So when we see very high values of MVRVZ, we're basically looking at the network being extremely profitable. There's lots of profit in the system, and when that happens, people are more likely to sell, which is how we get these tops get put in. And we can see that we did, in fact, have this peak get put in around February. And note, we also had this bearish divergence. And we actually, the same as our NUPL metric, there is a bearish divergence in play here. And the reason being that more of those coins, the realized value, coins were sold from lower prices to higher prices, increasing their realized value, which is increasing the denominator, the RV portion of this ratio, which therefore means that there's more coins at a higher level, and thus there is more supply that needs to be absorbed. There's people who, when the price falls from 60K down to 50 or down to 40, they then start to panic and go, well, maybe I should sell my coins because I'm now underwater. So it creates that psychological barrier where people, when the price falls down, they're then incentivized to sell because they essentially see red in their portfolio. So it's interesting that we see the same divergence in profitability in both the MVRV and the NUPL metric. It makes sense. A lot of the inputs are market price and realized price. So it makes sense that there's a connection there. But it's just a very interesting tool set. Whereas in 2017, this was very different. See how we came up and hit the same peaks each time? This is almost equivalent to seeing that the profitability, people were willing to sell at this level of the MVRV. This is where people decided that that was enough profit and I'm willing to sell my coins. We came back, we retested that psychological level, pulled back, rallied again. And then if you think about this, if people were willing to sell at a profitability of 6, then they're most likely going to be very incentivized to sell at a profitability of 10. So that starts to speak to, yes, there was market strength, but also we've already seen that the market's willing to sell at this level of profitability. Once we get up here, it's pretty likely that even more people will want to sell, which creates that blow off top. So there's a few different layers here. You can think about that more like a bullish or a continuation divergence in 2017, whereas we had a very different element here in 2021, where we really did have a bearish divergence overall, was showing that too many investors had bought too many coins at the top, and that just creates a top-heavy market that is very sensitive to lower prices. Now, we've spoken a little bit about the realized price and the realized value. Now, this is a very interesting concept, and this is a metric that Dor Shahar, who's very recently came up with this particular metric. What we're looking at here is the realized price to liveliness ratio. So the way to think about this, in the blue line, we have our realized price. This is the average price. It's kind of when every coin was last moved, what's the average of those values? And it's currently trading down here about 24,300. Now, generally speaking, the MVRV will come down and retest the green zone for that MVRV zone is essentially when price falls back to the cost basis. So in a very, very grim scenario, we may see price come back and test that level down here at 24,000. But that really represents that overall cost basis for the market. And typically tends to set some kind of floor. You can see here in 2018 and 19, we traded underneath it for a while, and that really marked the generational bottom. March 2020 traded and touched that level. And the same in 2015, when the market was underwater, under the cost basis, it was that generational bottom formation. So we do have that strong level of support down there. Obviously, as most of us probably wouldn't want to see price down there, it does represent a strong level of support. Now, what Dor did is he looked at the liveliness metric, which essentially is a tool that shows us when hodlers are hodling and when they're not. So think about this. If we have the cost basis and hodlers are not selling, that probably means that hodlers believe that prices should go higher, right? If there's more hodling going on, they're not willing to sell. Now, conversely, if they are willing to sell, then the cost basis of the market should rise, which is what we see in bull markets. And it overall, what the fair value for the hodlers is should be higher, right? It's closer to our cost basis. If people are selling, then that means that price that the coin is moving at is what they believe is fair value because they want to exit the market. So what Dor did is he took a ratio of these two metrics and developed this yellow curve. And what I like to think about this as is the hodler fair value. It almost represents what the hodlers believe that Bitcoin is worth. And note how through 2017, it provided support almost all the way up in the bull. So in the bull market, we tend to trade above fair value. This is euphoria. This is hype. We did it again in 2021 where the market traded above fair value. It actually caught the July dip, and you can see we've just broken below it. So overall, the market is currently trading below what hodlers believe is fair value. However, in a bear market, note that we can actually trade in between the cost basis and the fair value for an extended period of time. So the bull trades above fair value. That's a hype premium. During the bear, it tends to correct back down. And if you look at 2018 and 19, see how the fair value is kind of the middle. It really captured most of 2019, most of 2020. The fair value kind of becomes that middle zone. And in the bear, it tends to trade down below it. And then during the very late stage of the bear, at the end of the capitulation, when the maximum damage has been done, price falls below the actual cost basis of the market. We see it here again in 2020, which caught that low, and we see it here in 2014 and 15. So where does that put us in the current market cycle? Well, we've clearly had our premium, right? This is our hype premium. We did bounce off the fair value, so it shows that it can step in as support as we've seen through these levels. Unfortunately, it looks like we've broken down below it. Now, it's currently sitting about 39,200. Should price decide that and the market rally to reclaim that and hold it with some gusto, then perhaps we can start to turn this ship around. But should we start to really trade lower and it starts to look a little bit more like 2018, then perhaps that's telling us that we are in fact in somewhat of a bearish trend, and it could very well go on for some time. We can see that this takes a number of months. But it also provides us with a few bounds, right? We've seen that the realized price, which many people in the market are aware of, is likely to provide some kind of support because it has shown to be, over history, a very, very rarely visited but very strong support level when it does. So at the moment, we're trading in between the hodler fair value and the realized price or the cost basis. So it is certainly, we're kind of in that zone where the market needs to decide, are we going higher, or do we have to spend a number of months down here and form some kind of accumulation bottom? But at the very least, we now have a tool to really map on these different bands that we can use to track whereabouts we are in that cycle. Now, just by the way, you'll find the realized price to liveliness ratio as a preset under market indicators inside Workbench. So everybody who has a Glassnode account will have access to this tool, everybody who is advanced and above. So you should have access to this tool and you can start looking at where these different levels actually are. So as we've kind of established, it looks a little bit like a bear market. There's a number of characteristics, a number of patterns that we've seen in the past that really are mapping to investor profitability is not great, sentiment is not great, and now we start looking at how investors are actually behaving. And this is where it gets pretty interesting. I mean, as if it's not interesting already. So what we're looking at here is the net realized profit and loss. This is of all the coins that moved over the last couple of days. We looked at that realized value, how many were in a profit, how many were in loss, and we're looking at what is the overall net outcome of that. Now, what we can really see is this massive red spike down here, about it's almost $2 billion or $2.5 billion in a single day. So what that's showing is if you look at all the profitable coins and you subtract all of the coins that realized a loss, overall, a net $2.5 billion was essentially outflowed from the market. And you can see that the scale of this capitulation is very, very similar to what we've seen in the May sell-off. We saw it again in June. We saw it on the December 4th, and now we've had the next one here in January. So generally speaking, these large capitulation events typically signal some kind of a bottom. If we actually go down to our just standard realized loss chart, note how each of these spikes tend to occur at the low of a correction. Now, this makes sense because as price goes lower and goes lower and goes lower, people realize, oh, wow, what if it's not going to stop? And then they sell out in panic and fear. Now, we can see that we've had this level, but we also haven't had the dramatic bounce yet. So historically, yes, we do get elevated periods of losses being realized at bottoms. But we also need to see the market step in and start taking that and pushing it higher. Because if it doesn't, you can see that this has been elevated for some time now. See in May where it peaked up and then sold back off, we saw a big capitulation event and then the spending really slowed down. Here we're actually seeing the realized losses accelerating as the correction goes on. So it really is showing that people who did buy the top are being shaken out. This is what's happening. Really, it comes down to demand then. Can the demand actually absorb that supply? Now, the other thing to note is that our realized profit is not doing the same. We are seeing realized profit decline quite substantially. And this actually speaks to another phenomena. So there's really two elements to this. There's those who are selling out of panic and fear and realizing losses, and those who are not because they have profitable coins, they're long-term holders, or they just believe in Bitcoin for the long term. And what we're seeing is that class of folks, people who have coins that are in a significant profit, are not spending. So there is conviction here on one side, but we're also seeing additional sell side coming in, which is actually accelerating over time. So it really comes down to a question of, do we have the demand coming in to absorb those coins? And when we ask who is actually doing a lot of this spending, we can look at our short-term holder SOPR, which is our spent output profit ratio. Very similar to what we looked at here with our net profit and loss, except this is the whole market in dollars. This is a relative metric and it's only looking at short-term holders. And we can see that they've been underwater. All of the coins they've been spending have been underwater for some time. And this week it actually accelerated. So disproportionately, short-term holders are the ones who are currently spending their coins. Another phenomenon to pay attention to, note how SOPR in a bull market comes down and tests a value of 1 and then bounces. This generally means that it's pulled back to everyone's cost basis. They're stepping in and buying the dip and then we rally higher. Now, in a bearish trend, we're coming up and we're testing 1 from the underside and being rejected. What does this mean? It means that the overall market is coming back to short-term holders' cost basis. They're trying to get their money back, just get me out at my where my entry price was. They're taking whatever exit liquidity they can, and then the market trades down lower. So this is, again, it's starting to signal more of that bearish pattern. And it ultimately comes down to, with all of this sell side, and note that this is not yet at the extremes that we saw back here in May, June, July. So it could get worse. But also, it may, if it doesn't get worse, perhaps the demand will be enough to absorb it. So we're looking at this balance between, is there enough demand? Are people selling more? Is that accelerating? How are these two dynamics playing out against each other? And it is a complex puzzle. It's not easy. We have to look at multiple metrics to try and piece it all together. And just lastly, to close out on the supply dynamic side. So we've talked a lot about, that was really the spending patterns. We've looked at things like the investor sentiment and the profitability, and that really establishes what's the likelihood of these different entities actually selling. Now, what we have here is actually one of my favorite metrics. This is the long and short-term holder supply and profit and loss, which is a bit of a mouthful, but it also is a pretty useful tool. So in the blue, we have the proportion of supply that is outside exchanges. This is from 0 to 100%. Exchange supply is not included here. So exchange supply plus long-term supply plus short-term supply is circulating. So I also like to call long-term holder and short-term holder supply, when you add them together, sovereign supply. It's all the supply that's been pulled out of exchanges and investors hold in their wallets. So as a proportion of sovereign supply, the total amount of blue is long-term holders. The total amount of red is short-term holders. The dark colors are those coins that are in profit, and the light colors are those that are held at an unrealized loss. So there's a few things to observe here. Let's just talk through the last 2 years. We saw this point here in October 2020, which I call peak hodl. So this is essentially where long-term holders hold the maximum amount of supply, and generally it coincides with the market coming up and getting to the previous all-time high. Now, as the market breaks that all-time high, long-term holder supply declines. They're spending, they're selling into strength. Short-term holders are stepping in and buying those coins, which is essentially what we looked at in the first part of this video, where they're essentially getting their cost basis. They're buying coins at a higher level from the long-term holders, and therefore we have a lot of people who are more sensitive to price falling below 50, 60,000 than we did back here, where people have essentially weathered a 2-year bear market and they don't really care what the price is because they've been through the pain. Now, we had this period of peak distribution, which really coincides, and this is very common, coincides with the top. Then we start to see accumulation. The long-term holders who bought during this early phase of the bull start hanging onto their coins. We get coins getting older than 5 months, older than 6, 7, 8, 9, 10. And we can actually see, here's our supply 1 year old. These are coins bought from October through to January in 2020 and 2021. It's ripping higher. So we know that all of these coins that were purchased in this first phase of the bull are actually now hitting that 1 year old territory. Now you can see that as we push to the all-time high in October and November, we actually saw that obviously both of them, short-term holders and long-term holders, came back into profit. But long-term holders who normally start distributing, as we saw here at this all-time high, they normally start spending quite a bit. This really didn't happen. They spent a little bit, but even during this correction, they still haven't liquidated. So again, this is starting to speak to that realized profit chart. Maybe the long-term holders really do have a much, much longer term conviction and simply aren't spending yet, which is quite remarkable. Now, obviously, if that changes and we start to see the supply really start to decline significantly, then yes, that would start to be a cause for concern. And adding to that, note that the light blue, look how much it expanded. About 6.4% of the total sovereign supply held by long-term holders went into a loss during this correction. So there's a lot of long-term holders whose cost basis is somewhere between 43,000 and 33,000. So there's a big zone, there's a big chunk of coins that are owned by long-term holders in that price band. Now, on top of that, our short-term holders, now this is where a lot of the spending we've already established is coming from these folks. They are currently very, very underwater. Almost the entire short-term holder supply is currently held at an unrealized loss, which makes sense. If we go back 155 days, which is that threshold, it makes sense because almost all of that, well, all of that, in fact, is within this current price correction, either the rally higher or then in the correction to the downside. Now, there's always going to be some short-term holders who have stepped in and bought the dip, and they're going to be in profit. Now, what we really have to look for over the coming weeks is, do we see long-term holder conviction waver? Do we see more demand start to creep in? Do these realized losses really start to accelerate? Do we get more capitulation events? And we have to bear in mind that a lot of these things are driven by the macro market. It's a very, very big and complex world, and there's a lot of moving pieces right now. So Bitcoin is a global asset that's, the market is reacting to all of these different forces. So look, it is a very interesting market at the moment. I'm certainly paying attention to many of the metrics that we've covered in this session. I'm looking at spending patterns, seeing what investors are doing. There's certainly a lot of signs that say maybe a bear market is in play, but simultaneously, the underlying supply dynamics still remain impressively strong. To be honest, I haven't seen a market cycle where it has remained this way, albeit that can come for a number of months it takes to actually work these kinks out. So it is something just to set expectations, to understand that it is a bearish market right now. Do let us know what your thoughts are. Let us know what you like about these videos. As I mentioned, we read through all of your comments. We're certainly always learning about how we can bring more and more content to you. We did release a video last Friday that was surveying this sell-off and tried to map out some of these different metrics. We're going to be looking to put out more videos more frequently, so do let us know what your favorite metrics are, what you want to see covered, and we look forward to getting through them. And until the next one, I'll see you then. Cheers.